Many investors, even seasoned investors, get confused when they hear market pundits tell you that you should buy the dip when the stock market sells off. Half of them will put all of their cash to work on the first day there's a sell-off. The other half will wait, thinking that the stock market will sell off even lower and not put any cash to work until the market has sold off to their target. Neither of these approaches works that well. If you put all of your money to work on the first drawdown, the stock market could sell off significantly lower, like it did in 2018. Where it started to sell off in September and sold off 19.9% between then and Christmas Eve. If you put all of your money to work when the market sold off 1 or 2% on the first day or two, then you would have missed out on the opportunity to buy 19% down. However, alternatively, if you keep waiting for a more serious pullback, then it's possible that the stock market won't pull back that much at all and will just rally to new all-time highs, leaving you with all of your cash on the sideline, having missed the opportunity to put it in. My name is Eric, my nickname is Irk, and I have been investing in stocks since 1998. So what does buying the dip mean to me? Buying the dip means putting your money to work in stages, buying in stages as the stock market sells off. This way you can capitalize on better and better prices as the market sells off lower and lower. The way I buy the dip is that I create a buying plan for every single one of my investments in advance. I pick what the next target is where I'm going to buy, and then the next one after that, and so on. So when the market starts to sell off, I don't have to think about where or when or how I want to buy. I already did that in advance. So how can investors make that buying plan? Well, there are a couple of ways to do this. An easy method to do this is to just buy in percentages. For example, if you choose a 2.5% increment, then you would buy every time your asset sells off 2.5%. Once it's sold off 2.5% from its all-time high, that would be your first buy. Then 5%, 7.5%, 10%, and so on. Putting money to work at each of these 2.5% increments. Keeping in mind that the deeper you wait before you start putting your money to work, the less likely it is that the asset might be able to get that low. It all depends on how conservative or aggressive you want to be about putting your cash to work. Alternatively, my method is to use relatively simple technical analysis to find potential buying targets. The idea of looking at charts can seem intimidating to some new investors and even ones that have been around that long. But it's not really that difficult, and you can use any charting software to do this. You don't even have to pay money for it. Everybody has a free plan of some sort, and all we're going to use is support. So this is the S&P 500. Actually, it's the SPY, one of the ETFs that tracks the S&P 500. And as you can see, we've got this drawdown that happened from its all-time high to its August 5th low. And the drawdown was 9.71%. So if you were buying in 2.5% increments, you would have made 3 buys on its way down, at 2.5% down, 5% down, and 7.5% down. But since it didn't make it all the way to a 10% drawdown, you wouldn't have bought at the low. But one of the great things about charts is that you can see this was the capitulation point. SPY sold off to $510.27, and this is where the sellers stopped selling and the buyers stepped in. In the future, that means this will be another support level because there are a lot of people who saw that it sold off that low, didn't get to buy at that low, and now they want to. So chances are SPY will find support there. However, it's also important to remember that might not be guaranteed and it might not stop at that point. So even if the S&P 500 sells off to that point, it's possible that it might stop there. It's also possible that it could go lower. So this is how I find my next buy target. You can see we have these points throughout the past where there are key capitulation points where it found support and then bounced from that level. Again, there are no promises that we could get back that low or that it will hold. So being conservative or aggressive about putting your money to work means how quickly do you want to start? Some investors might actually start at this most recent drawdown at $539.44 and then use mid-level drawdowns on the way down to put money to work as the S&P 500 sells off. Additionally, another method that you can use is what's called the pyramid buying method. If you had a set amount of money that you needed to put to work, let's say $10,000, you could buy $1,000 at that $539 mark and then $1,500 at the $528 mark, and so on, increasing the quantity that you buy the deeper it sells off. Also, since we do know that these are potential levels of support, you can choose how aggressive you want to be. Personally, I don't want to wait until the investment hits that level of support before I do my buy. I want to make sure I get my money to work. So instead of waiting until $539.44, I might actually use the close of the day, which is this line right here, this base of this candlestick at $540.36. So a buy target I might use might be $540.50 to ensure that I have gotten in above that support level. And then I would repeat that process for each one of the lows that you see. And you can see how support works. When the SPY pulled down to $528.60 on this day, that point also acted as support on the way up, when on this day it pulled back, and that was the low of the day at $528.56. It's important to think of support kind of like you'd think about jumping on a mattress. Yes, the mattress will support you, but you sink into it. So when an asset sells off, sometimes it will go through support, but still find support at that level. And this doesn't just apply to SPY. You can go down to a variety of different assets and see where they sold off on August 5th. For example, this is a chart of gold, and you can see that it came down, found support here, and bounced. So this would be a good price target in gold. Looking at other assets, you can see on this chart of NVIDIA where the stopping point was on August 5th, down here at $90.69. So it's an interesting approach because you can find those support levels across the board when we have a market-wide sell-off. It's almost as if the market drew the curtains back and showed you where everybody's buy targets were on every asset. Whenever there's a market-wide sell-off, it's a great way to find new levels of support to use as buying targets. The important thing to remember is that my next buy is never my last buy. I always have that buying plan in advance so that I can prepare for if the stock market sees a more dramatic pullback. However, I'm also putting money to work pretty early during a drawdown because I've always got cash on the sidelines and I don't want to keep it as cash for too long. It's a fine balance that every investor must find for himself or herself. They must figure out where they want to put the money to work and how much of a drawdown do they want to wait for before they do. The goal is not to try and pick the bottom on the way down. This isn't gambling. You're not making a guess. You can't just be right about where the bottom is. This is investing. If I'm wrong about how low we might go and I go in too soon, then I could miss a great buying opportunity. However, the alternative is even worse, in my opinion. If I wait too long and I miss the bottom, now I have to buy into a rally. Think of all the investors who refused to put money to work when the S&P 500 was down more than 20% and the NASDAQ was down more than 30% in October of 2022. A lot of these investors thought that the stock market was going to sell off even more, so they didn't put money to work. And then the stock market bounced. All of these investors with cash on the sidelines waited because they thought that the market would sell off again and test those lows, which it never did. So you're left in this uncomfortable position of figuring out when you want to put the money to work. If you think it's going to pull back, you don't want to put it to work. But then if it just keeps rallying higher and higher, you could miss a 30+% gain, which is what happened from those October lows. The priority for any long-term investor, of course, is to put their money to work. And if you're like me, you've always got new money to put to work, which means it's not just the set amount of cash that I have in my accounts right now. I'm regularly funding them with even more cash that also needs to be put to work. For me, it comes down to this. If I think that an investment is going to be worth more in 20 years than it is today, then today is a good day to buy, regardless of where the price currently is. To learn more, read my blog at getirked.substack.com.